Welcome back. And hopefully you're feeling pretty confident about how to use the pension plan workbook. So we're going to look at 2017. We'll still be using the data on page 1179 of the textbook. The first thing to remember is that the balance at the end of last year is the balance at the start of this year. So we're just using exactly the same numbers as at the end of last year, and we remember that the balance in the plan assets was $111,000. Of course, the data sheet also tells you this, and that the defined benefit obligation was $112,000, and as a result, we have a net liability. The plan is underfunded. I want you to remember as well that we used a few simplifying assumptions. We start with the current service costs. We're assuming were credited to the defined benefit obligation at or near the year end. And we make the same assumption regarding the contributions to the fund and also to benefits paid to the retirees. We make those assumptions unless we're told differently. Now, this is important because the interest and finance costs are calculated for the amounts for the year. All right. So we'll take a look at what that means to us with this. In 2017, the company amended its defined benefit pension plan to grant prior service benefits to certain employees. So this is just going to include some employees who had worked prior to the plan starting up, and they're going to extend some additional benefits to them. And this was done on January the 1st, 2017. So we can see here that this was increased. The defined benefit obligation was increased by $80,000 on January the 1st. That is an expense to the company. So it affects the accounts in the same way that the current service costs do. They represent an expense to the company, and also they increase the defined benefit obligation. But now, as a result of this, we see that at the beginning of the year, the balance at the end of the year, plus the past service benefits that were granted on January the 1st, means that the defined benefit obligation at the beginning of the year is $119,000. So when we calculate the net interest finance costs, we're going to be looking at both the balance at the beginning of the year, plus the past service benefits that happened on January the 1st, and we're still using 10%. We see from the question that the current service costs for the year were $9,500, and we do this exactly the way we did it before, recognize the expense and the increase in the obligation. Now I want you to notice that the actual earnings on the plan now are $11,100. The actual earnings are equal to the interest at 10%. So $111,100, and the actual earnings were exactly 10%. So this is still rather coincidental. Remind you again that plan assets held by the plan administrator are invested in all sorts of things: mutual funds, shares, bonds, interest-bearing things, whatever the plan administrator believes to be good, solid investments. And you know from your studies in accounting and finance that we can't predict with any accuracy how much in the short run these plans will pay. And of course, it's even possible for them to lose money, so that the actual earnings could be less than $11,100, for example. But in this particular case, we're seeing that the actual plan assets are still equal to what we were hoping for 10%. But there's a difference here. In order to look at this correctly, we see we now have an additional expense. Do you see that? We have increased the obligation by $19,200, but the plan has only earned $11,100, meaning we have an additional expense of $8,100. So the net amount of those two is entered in the pension expense column. Okay, the question tells us that there was a contribution to the plan of $20,000. Write that check, credit cash, and debit the plan assets. The benefits paid were $8,000. That's going to reduce the defined benefit obligation, and it also reduces the plan assets. Remind you again, these are notational only and not part of our journal entries. So over here, we're keeping track of the things that do form our journal entries. I add this column up to get $97,600. I add this column up to get the credit of $20,000. This $97,600 is a credit to the net defined benefit asset liability, and this contribution is a debit to that amount. So this now forms, the blue part forms my journal entries. And our balance sheet will show a net defined benefit liability of $78,600. Keen, eh? Oh, there's a word you don't hear often anymore. Peachy keen. All right, as before, if you got lost anywhere in that, just play the video again, get a worksheet out and try and do it, and then compare your answer. Remember, these worksheets are replicated in the textbook as well, so you don't have to listen to me if you don't want to. Thanks. Next, we're going to do 2018 and add a couple of new complications.